So what we're going to do is we're going to talk a little bit about markets. And Brandon, I wanted to start by just having you talk about the national real estate picture. What's going on nationally? Why does it matter to these folks? What does it mean for their real estate portfolios moving forward in 2018?
You got it. So it's an interesting time in real estate as we just have ended out 2017 and jumping into 2018. I mean, it's funny when we started doing this, as the iterations of the company as we've evolved back in 2008, 2009, 2010, to see kind of what we had expected might happen as we were really starting to jump into the type of real estate that we've evolved from around that time when we were at the absolute bottom of the recession. You know, the housing crash that we've all familiar with, that we all probably experienced some pain in, whether we were investing in real estate, whether we were just looking at our own values of our primary home ownership go down, and all that kind of came with that. To see where we're at now 8 years later from that trough is remarkable. And really the thing that we're seeing a lot right now is we're kind of looking at the landscape, and as we're continually trying to acquire assets and these investment vehicles that we call single-family residences, right? Of where we can continue to do this and where we can still get the number of houses that we need to fulfill the demand of all the clients that are looking to do their real estate. So obviously we've been in, the markets we've been into this point are, we obviously started in Phoenix and Las Vegas. As that run-up happened that we expected to happen, and we've done a lot of deals with people selling out of those assets that they bought at the very bottom in Phoenix and Vegas in 2010, 11, 12. A lot of those we're starting to sell into a lot of new markets. The main markets that we're obviously in now, Florida, North Carolina, Memphis, and Indianapolis, all performing really well. All are looking to do well into 2018 as we're kind of looking forward. It's interesting, and we're going to talk a lot more about it with Ryan Heinricher as he talks more about what's going on in the Florida market. It's interesting, and I'd want to kind of have you pay attention to that run-up period that we were really doing a lot of deals, and the reason we jumped into Orlando, how that market is switching from a recovery market, trying to get back to those 2018 levels, or the pre-recession levels, and how that market is switching from that recovery market to more a traditional, healthy, and hot market where appreciation is still happening at an accelerated clip in Orlando, but it's for more different reasons than just inventory coming back into play like it was at the recession. So on a national basis, kind of what we see is going on, and what we're looking at in the long run is a lot of continued appreciation throughout all of the markets we're in. What we're really experiencing right now nationally on the housing sector is a dearth of inventory. I looked at a stat while I was getting ready for this where it talked about in a healthy market, the number of the months of inventory that are generally available are typically about 8 to 9 months of inventory that's there for people to buy, on a national scale. Where we're at right now at the end of 2017 is we have more like a 3 to 4 month supply of houses. So there's literally about, what that generally means is about half the amount of inventory for sale at any given time than there normally is in a given market. Now, from 2010, that number is, way off, but from even a normal market, inventory is tight. Now, what that means for investors that have already invested with us is that's great news, right? Because that tight inventory it's all supply and demand, and the push of houses going up is happening quickly. So we've actually, as we look back at 2017, we've actually experienced more appreciation in our cash flow or our stabilized markets than we even expected. So in markets like Indianapolis and in Memphis, where people are buying more for just the normal rental income that's coming in and not banking on that appreciation number, like what most of the people that were buying in Phoenix and Las Vegas in 2010, 2011 were doing, we're still hitting, north of 5% increased numbers annually for last 2017 in both Memphis and Indianapolis for the most part. we usually kind of projected more like 3% in some areas where we felt really confident we were doing 5%. But what it looks like is we've actually exceeded those numbers in those cash flow markets. And in the Florida market, it still looks like we've been at that 10% clip, and in some instances hitting above that throughout all of 2017.
Well, and real quick, Brandon, this is really important. For those of you that maybe don't know our company or kind of our history, so generally speaking, our clients over the last 5 or 6 years, we've had really 2 strategies that they've relied on. One is go to a more stabilized market, as you described it, that maybe is experiencing 1%, 2%, 3% appreciation. Not drastic appreciation, but higher cash flow. Maybe slightly lower purchase prices, higher cash flow.
Exactly.
And that's been more of sort of this long-term approach to, I'm going to own real estate, I'm replacing my income one investment property at a time. That's been something that some folks have done to generate more cash flow. But then there's been these other markets, specifically Orlando, which maybe the cash flow, monthly cash flows were less. Maybe purchase prices are a slight clip higher, but the reality was with Orlando, there was a rebound that was happening. So somebody looking to say, I really want to grow with appreciation and grow my portfolio in equity would maybe invest in Orlando, while somebody who just wanted to have a more stable cash flow approach was investing in some of our other markets. What I hear you saying is that's been the approach for a lot of our clients, but in reality, even our stable cash flow markets have seen more appreciation than anticipated, and Orlando is tracking and maybe even exceeding the appreciation numbers that the folks hoping to get growth were seeing, right? That's
100% right. That's 100%. And we really like having the 2 types of investments for our clients. The cash flow model, the higher cash flow model without as much appreciation is more traditional type of real estate, but we also have people that that appreciation factor is a little bit more subjective, right? There are blips and hiccups and things like that could come to a market where that may not happen the same way that we would realize it is, and so there's a little bit more risk involved with those. But that's the part of what we do that we try to take that risk out of it, and we've got a track record over quite a bit of years of kind of hitting on those numbers right. So, but that's kind of the trend we're seeing for 2018 is that tighter inventory is still really pushing up home prices. What we've also started to have to kind of do is, in trying to get creative and finding new inventory, is we have started to do a lot more of setting up relationships with developers where we could get absolutely new out-of-the-ground product. So new homes that are basically being built for our clients that people could jump into and buy. And they're not our normal model, quote unquote, of buying a distressed asset, rehabbing it, and selling it at or below market value to our clients. These are houses that we're actually forming relationships with builders, and they're building houses to spec for our clients.
Now here's what's really cool about this. I think this is so exciting, and we'll talk about North Carolina in a second, Charlotte, where this is happening. One of the things that I really love about Brandon is he'll come into our office on a regular basis and he's excited about something or he's concerned about something, but it always is the same story, which is he wants to make sure that the assets we're helping our clients acquire are the right ones for their game plan moving forward. And he works unbelievably hard to do that. What he was able to uncover along with his team is that while we've had this model of going and purchasing homes in some markets, whether it was a cash flow, more stable market, or a growth market like Orlando that would produce cash flow but some growth, those were homes that, depending on the market, could have been as old as what? Some of the older homes?
Late 70s, early 80s. Sometimes we've gone in some specific ones even older than that, but the typical one for us is in the 90s. 90s or early 2000s is
and
normal.
Some markets are 90s and early 2000s, and that was kind of the model. But now, with the market doing what it's doing, there's this opportunity where we can go and form relationships with builders. While still doing that model, there's this other opportunity that he's discovered that's emerging for our clients to actually get product that's coming out of the ground that's new product, that's still conducive to the game plan, to the redefinition of the retirement, and replacing that income and generating that cash flow, which I just think is so cool. And it's one of the reasons I love what we do, because can you imagine just being an individual real estate investor thinking you want to do real estate and trying to figure out what type of real estate to do, what market? How would you know when it's time to get new build, when it's time to get an older home, what year that home should be? And if it varies by market, you can imagine how daunting that would be. That's all Brandon thinks about. Which I just think is really cool, and it's created this kind of amazing opportunity that's a different type of opportunity for our clients that have been with us for a long time.